Welcome back to X100%. I'm your host, Eddie. Today, we are doing something different. Usually, we talk about broad concepts or we scatter our focus across multiple stocks. But today, we are going to dedicate this entire session to just 3 letters. QQQ. If you are listening to this, you have probably seen it in headlines. You have seen it on Reddit. You might even have it in your portfolio right now. The Invesco QQQ. It is one of the most traded, most discussed, and most celebrated exchange-traded funds in the history of financial markets. But here's the problem. Most people buy it blindly. They buy it because they see a green chart. They buy it because their friend told them tech is the future. But they don't actually know what is under the hood. They don't know how the machine works. They don't know the strange history of how it was built, or the massive changes that just happened to its legal structure just a few weeks ago, changes that actually put more money in your pocket. But for the next 20 minutes or so, we are going to go deep. We are going to strip this ETF down to the bolts. We are going to look at the new fees, the secret sibling fund that might still be better for you, the updated sector breakdowns, the risks that nobody talks about, and the philosophical reason why this specific basket of stocks has created more millionaires in the last 2 decades than almost anything else. By the time this episode ends, you will not just be a passive investor, you will be an expert on the QS. Let's start at the beginning, and I mean the very beginning. To understand QQQ, you have to transport yourself back to a very specific moment in time, March 10, 1999. The world was different, the internet was dial-up, Amazon only sold books, and the stock market was in a state of absolute euphoria. This was the dot-com bubble. In the middle of this mania, Invesco launched a fund to track the Nasdaq 100 index. They called it QQQ. They marketed it aggressively. They had commercials during major sporting events. They positioned it as the ticket to the new economy, and for a few months, it worked. If you bought QQQ in 1999, you felt like the smartest person in the room. You were making money hand over fist. And then the year 2000 arrived. The bubble burst. I want you to visualize this chart. Imagine standing at the top of a mountain and then jumping off. QQQ lost nearly 80% of its value. 80%. Imagine putting $100,000 into this fund and watching it shrink down to $20,000. It was a bloodbath, and here is a detail most people miss. It took roughly 15 years just to break even on the price alone. If you were reinvesting your dividends, the total return recovery was a bit faster, about 12 to 13 years. But still, imagine waiting over a decade just to get your money back. Now, why am I telling you this horror story to start the episode? I thought this was supposed to be a great investment. I tell you this because you need to respect the volatility. QQQ is not a savings account. It is a high-octane growth engine, and after that crash, something incredible happened. The companies that survived, the Amazons, the Microsofts, the Apples, they didn't just recover. They took over the world. Since the bottom of the financial crisis in 2009, QQQ has absolutely destroyed the performance of the S&P 500. It has been the best-performing major market index fund of the 21st century. So what exactly is it? When you buy one share of QQQ, you are not buying the tech sector. That is a common misconception. You are buying the Nasdaq 100. Here is the specific definition. You are buying the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. There are 2 key phrases there, largest and non-financial. Let's talk about non-financial. This is the secret sauce. The S&P 500 includes banks. It holds JP Morgan, Bank of America, Wells Fargo. QQQ does not. By law, the Nasdaq 100 excludes the financial sector. Why does that matter? Because banks are cyclical. They depend on interest rates. They are regulated heavily. They are generally slow-growth value plays. By kicking the banks out of the club, QQQ naturally filters for companies that grow through innovation, intellectual property, and consumer demand. It accidentally created the perfect growth filter. Now let's look at the largest part. QQQ is market cap weighted. This means the bigger the company, the more of your money goes into it. As we speak right now in early 2026, the fund is dominated by the Magnificent Seven. I'm talking about Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, that's Google, and Tesla. Now you might be wondering, what about Broadcom? Well, Broadcom might not be in the original Mag 7 catchy nickname, but make no mistake, it usually sits comfortably in the top 10 holdings as a titan of the semiconductor world. In fact, the concentration is something you need to be aware of. The top 10 companies in QQQ often account for nearly 50% of the entire fund. Think about that for a second. There are 100 companies in the basket, but half of your money is sitting in just 10 of them. Critics hate this. They say it is not diversified. If that concentration scares you, there's actually an alternative called QQQE. That stands for equal weight. In that fund, you own the same 100 companies, but you own roughly 1% of each. It sounds safer, right? But be warned, historically, QQQE often underperforms during massive tech rallies because you don't get the full benefit when the giants like Nvidia or Apple go parabolic. You're capping your winners. But for the standard QQQ, I look at the concentration differently. I say it is a feature, not a bug. It represents the winner-takes-all economy. By owning QQQ, you are letting the winners run. However, it is not just technology. This is another thing people get wrong. Yes, as of 2026, the fund is heavily tilted toward tech. We are talking roughly 60% to 64% pure technology. But what is the rest? You have consumer discretionary sitting at around 18%. You have healthcare at about 5%. And the rest is scattered across industrials, utilities, and consumer staples. It holds PepsiCo, it holds Costco, it holds Starbucks, it holds Monster Beverage. Wait, Pepsi, Costco, why are they in a tech ETF? Because remember the rule, largest non-financial companies on the Nasdaq. Pepsi is on the Nasdaq, Costco is on the Nasdaq. They are not banks, so they get in. And here is a hidden gem most people overlook, international exposure. You are not just buying American companies. You own ASML, the Dutch company that makes the machines that make the chips. You own AstraZeneca, the pharma giant from Europe. QQQ gives you global diversification without you even realizing it. Now let's get into the technical stuff, the fees and the structure, and pay attention because this part has changed recently. For over 20 years, QQQ had an expense ratio of 0.2%, and it was structured as something called a unit investment trust, or UIT. It was like an antique legal structure from the 90s. But in December 2025, shareholders voted to modernize. As of early 2026, QQQ has converted into a modern, open-end ETF structure. Why should you care? 3 reasons. First, the fee dropped. It went from 0.2% down to 0.18%. That's more money in your pocket. Second, it eliminated cash drag. In the old days, when Apple paid a dividend, the fund manager had to just let that cash sit there doing nothing until the payout date. Now, they can reinvest it immediately. Third, and this is huge for efficiency, the fund can now engage in securities lending. They can lend shares to short sellers and earn interest on them, which helps offset the costs of running the fund. So QQQ just got leaner, meaner, and cheaper. But I still have to tell you about the younger brother, QQQM. QQQM still exists. It tracks the exact same index. It holds the exact same stocks, but even with the QQQ price cut, QQQM is still slightly cheaper at 0.15%. So we have QQQ at 0.18% and QQQM at 0.15%. The gap has narrowed significantly. It used to be a wider spread, but now it's very close. So why does the original QQQ still exist? Why do people pay that extra 0.03%? Liquidity. The original QQQ trades millions of shares a second. It has massive options markets. If you are a big institution or a day trader, you need that liquidity. But if you are a long-term investor, if you are listening to this podcast and planning to hold for 10 or 20 years, QQQM is still technically the mathematically superior choice. But honestly, with the new fee cut, holding the original QQQ is no longer the expensive mistake it used to be. Both are now excellent choices. Let's pivot to the philosophy. Why has this basket worked so well? The answer lies in one acronym, R&D, research and development. The companies inside the Nasdaq 100 spend more money on research and development than any other group of companies on Earth. We are talking about hundreds of billions of dollars a year poured into AI, cloud computing, biotechnology, and automation. When you buy the S&P 500, you are buying everything. You are buying the disrupted and the disruptors. You are buying the old energy companies and the old retailers that are dying. When you buy QQQ, you are heavily tilting your portfolio toward the disruptors. You are betting on the companies that are building the future. Think about the asset-light model. Look at a company like Meta or Alphabet. To make more money, they don't need to build a new factory. They don't need to buy raw steel. They just write code. Their margins are incredible. In an inflationary environment, these companies have pricing power. That is why they have been so resilient. But we have to talk about the risks. I cannot let you walk away thinking this is a magic money printer. The volatility is real. We measure volatility with something called standard deviation. QQQ has a much higher standard deviation than the S&P 500. In 2022, when interest rates hiked up, QQQ dropped 33%. Imagine 1/3 of your wealth vanishing in a year. And we have to talk about the AI rally of 2024 and 2025. This surge pushed the valuation of companies like Nvidia through the roof. At one point, Nvidia alone accounted for nearly 9% of the entire portfolio. This is a double-edged sword. It drove massive returns, but it also means that if the AI bubble bursts or if regulation hits the chip sector, QQQ is going to feel the pain much more than the broader market. Also understand duration risk. Tech stocks are long-duration assets. Here is what that means in plain English. A lot of the value of a tech company is based on money they are going to make 10 years from now. When interest rates are low, that future money is worth a lot today. When interest rates go up, that future money becomes less valuable today. So QQQ is highly sensitive to the Federal Reserve. If the Fed raises rates, QQQ usually gets hit harder than the Dow Jones. You have to be prepared for that seesaw. Also, there is the valuation risk. The price-to-earnings ratio, or PE ratio, of the Nasdaq 100 is almost always higher than the rest of the market. You are paying a premium. You are buying a Ferrari, not a Toyota. If the engine stalls, the price of the Ferrari drops much faster than the price of the Toyota. Now, I want to briefly mention the cousins of QQQ because I know you have seen them. You have probably seen TQQQ. That is the triple leveraged version. If QQQ goes up 1%, TQQQ goes up 3%. And you have seen SQQQ. That is the inverse. If QQQ goes up, SQQQ goes down. Hear me clearly, these are gambling tools. They are not investments. They are designed for day traders. If you hold TQQQ for a long period, something called volatility decay will eat your money alive. Do not confuse TQQQ with QQQ. One is a long-term wealth builder, the other is a casino chip. Stick to the plain vanilla QQQ or QQQM for your long-term portfolio. We are coming into the home stretch here. I want to talk about the rebalancing. This is the mechanism that keeps the fund fresh. Every year, the Nasdaq performs a reconstitution. They look at the list. If a company has shrunk and is no longer in the top 100, it gets kicked out. If a new company has grown massive, it gets added in. This is why QQQ is immortal. In 1999, the top holdings were companies like Intel and Cisco. Today, it's Apple and Nvidia. If you bought individual stocks in 1999, you might have gone to zero. But if you held the index automatically sold the losers and bought the winners for you. It is a self-cleaning mechanism. You don't have to guess who the next Amazon is. The index will just add them when they get big enough. So who is this ETF for? It is for the investor who has a time horizon of at least 10 years. It is for the investor who believes that technology will be a bigger part of our lives in 2035 than it is today. It is for the investor who can stomach a 30% drop without panic selling. If you are close to retirement or if you need the money next year, QQQ is dangerous. But if you are in the accumulation phase of your life, it is arguably the most potent weapon you have. We have covered a lot today. We talked about the non-financial rule that filters out banks. We talked about the Magnificent Seven and the AI surge. We covered the massive structural change in late 2025 that lowered the fees and modernized the fund. We compared it to the slightly cheaper QQQM. Before we wrap this up, I want to crystallize everything we have talked about. I want to give you a cheat sheet summary. If you zoned out for a minute, listen closely now. Here is the summary of what you have learned in this episode. Number 1, QQQ tracks the Nasdaq 100 index. This means the 100 largest non-financial companies on the Nasdaq. No banks allowed. Number 2, it is heavily concentrated. Tech makes up about 64% of the fund, and the AI rally of 2024-2025 has made the top holdings like Nvidia incredibly influential. This is an opportunity, but also a risk to watch. Number 3, the fee structure has evolved. As of 2026, QQQ is an open-end ETF with a fee of 0.18%. It is now more efficient, with no cash drag and the benefit of securities lending. Number 4, there is still a cheaper sibling. QQQM charges 0.15%. The gap has narrowed to just 3 basis points, but for a pure buy-and-hold investor who doesn't need high-speed liquidity, QQQM is still the mathematically optimal choice. Number 5, it is volatile. It took about 15 years for the price to recover from the dot-com crash. You need a stomach of steel to hold this asset. Number 6, the secret sauce is innovation. You are investing in R&D, patents, and global brands, including international giants like ASML that have pricing power. And that is the story of the QS. It is a fund that was born in a bubble, survived a crash, and grew up to dominate the modern market. It is a bet on human progress. It is a bet that tomorrow will be more advanced than today. I hope this deep dive gave you the confidence to know exactly what you are holding. No more blind investing. Now you know the mechanics. Thank you for listening to this episode of X 100%. We are dedicated to giving you the full picture with no shortcuts. If you found value in this script, if you learned something new about the conversion from UIT to ETF or the nuances of the sector weighting, please subscribe to the channel. We have many more deep dives coming your way. Keep learning, keep growing, and I will see you in the next one. This is Eddie signing off.